Good afternoon, this is Sean Golden with Golden & Golden, here to discuss the basics of the foreign trust reporting and compliance, disclosure, and penalties. Foreign trusts are a big thing. With the IRS, they don't really like them. They think they can be abusive and fraudulent oftentimes, and so they're under a microscope. With a foreign trust, the first and most important aspect is to determine whether or not it's a foreign trust for U.S. tax purposes. It might be a corporation overseas. It might be a LLC equivalent, a foundation. It may be used for estate planning or for business purposes. But from a U.S. tax perspective, if it's considered a foreign trust, if it marks off those boxes, then it's going to be handled differently than it would if it's a foreign corporation, for example. One common scenario would be a Sociedad Anónima oftentimes is used for estate planning types of purposes and protections in foreign countries, but under U.S. tax law, it's a per se corporation and it has to be treated as a corporation, and a Form 5471 is filed instead of a 3520. So there's a lot of moving parts and some confusion and ambiguities to be aware of when dealing with foreign entities in general, foreign trusts specifically. So the first type of foreign trust is the foreign grantor trust. And we're just going to break it down. There's lots of different types of trust, but foreign grantor, foreign non-grantor. So the foreign grantor trust, owned by a U.S. person with a grantor trust, it is the grantor who pays income tax. So the purpose of that is to avoid artificially reducing taxation to high dollar grantors or high income grantors, and increasing the tax gap even further in a situation that grantor would pay it out to the beneficiaries who had a lower tax rate, and then they gift it back to the grantor. And then the U.S. misses out on a whole bunch of tax. They don't like that. So with the grantor trust, it's the grantor who is responsible for paying tax. Typically with a foreign grantor trust, it's taxable to the U.S. person. It can also be taxable to a non-U.S. person, a foreign grantor trust, when there's U.S. assets in it. That's beyond the scope of this, but just something to be aware of. It can technically be a foreign grantor trust with a non-U.S. person grantor and still be taxed in the U.S., at least to the portion that's considered owned U.S. assets, then 1040 NR and things of that nature. With a foreign non-grantor trust, it's a little bit different. It's the beneficiaries who are taxed, not the grantor. The grantor is no longer the one who controls the assets. Obviously, there's ways to maneuver around that, but from a baseline perspective, the beneficiaries are taxed. So when there is a U.S. person beneficiary and they receive a distribution, it's typically taxable, and hopefully they receive what's called a foreign non-grantor trust beneficiary statement, kind of explaining whether it's income or corpus. When you have foreign trusts, it gets complicated on the issue of UNI versus DNI, undistributed versus distributable income, the throwback rule, and things of that nature. It can make income that would ordinarily qualify as at a reduced tax rate to be taxed at a higher tax rate depending if it's the year it was distributed or not. So a lot of moving parts. Whether it's the grantor trust or the non-grantor trust, the two main forms that are filed is the Form 3520 and the Form 3520A. They're somewhat complicated depending on the purpose of filing it. If you're just reporting a trust distribution, not so much. But if you're the owner, the U.S. owner of a foreign trust, then it can be complicated. Failure to file the forms can result in significant penalties, even if it's a single person who owns the trust and is the beneficiary. Under the case of Wilson, I believe it's the 2nd or the 11th Circuit. In that case, at the Court of Appeals, I think it's the 11th Circuit. At the Court of Appeals, they said, hey, yeah, you're the single owner and beneficiary of the trust, but we're going to penalize you twice for failing to file the form as the owner and the beneficiary. So IRS really doesn't like foreign trusts. You may be able to avoid reporting the trust if it's like an RRSP or RIF in Canada. Revenue procedure, I think it's 2014-55 exempts having to do 3520, although you would still have to do the FBAR and FATCA if applicable. 2020-17 is a revenue procedure that works to reduce duplicative reporting of certain tax-deferred retirement and non-retirement trusts on Form 3520, 3520A, since it's presumably already being reported on the FBAR Form 8938, possibly 8621. If you're out of compliance in prior years, it's important to try to get into compliance before you get penalized. There are various programs available depending if you're willful or non-willful. If you're willful, you would do the voluntary disclosure program. If you're non-willful, there are a lot more options available. There's the streamlined procedures, delinquency procedures, and reasonable cause. We have a ton of free information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.